Hello everyone and welcome to my video on cash flow forecasts and introduction to finance. So this is for Into Foundation business students, and today I want to start off with a quick brain teaser. So the capacity of Brighton and Hove Albion Football Club's Amex Stadium is 30,750 and the average crowd for the season is 25,645. Average sales at each afternoon home game of the award-winning Piglets pies at the ground are 10,000, with sales being 20% higher at evening games. If the team draw Chelsea at home in an evening match in the Capital One or League Cup, and so expect a sellout, how many pies might they expect to sell? Now, what I'd like you to do is pause the video here and have a go at answering the question yourself. So it's important before we start this to remember that the answer is at best a guesstimate. Okay. So there are many factors that we consider when having a look at predicting sales forecasts. So, and as you remember from your economics and business previous lessons, you'll be able to have a good idea of the different sorts of things that may affect sales on a particular day. So we start off by having a look at the pies to people ratio. So the number of pies is 10,000 for every 25,645 people during normal home games. Now the Chelsea game is going to be played in the evening, so we need to increase the number of pies sold to reflect the new value. So sales rise by 20%, therefore we do 10,000 times 1.2, giving us 12,000. That gives us a ratio of 12,000 pies for every 25,645 people. We then do 12,000 divided by 25,645, giving us 0.47. Therefore, the stadium capacity, assuming the ratio remains the same, we do 30,750 times 0.47. Giving us 14,452.5 pies. We can't have 0.5 for pi, so we round it out to 14,453. So this is finance, part 1, introduction and sales forecasts. By the end of this, you should have a basic understanding of the financial terms, how to calculate basic financial items, how to create a sales forecast, and note the difficulties in creating a sales forecast. So sales revenue, also known as income, turnover, revenue, total revenue, and sales revenue, is basically the money you gain from selling your product, whether that be a hairdresser selling haircuts or a table maker selling tables. Sales volume, okay, is the amount of sales that we make. How many units do you sell? So we can calculate this by taking the sales revenue and dividing it by the selling price. So for example, a company has a sales revenue of £50,000. The selling price is £2.50. To calculate sales volume, we simply do 50,000 divided by £2.50, giving us 20,000 units. We can also calculate sales revenue by taking the sales price or the selling price and times it by the quantity sold. So for example, if a company sells 20,000 units at a price of £2.50, the sales revenue is calculated by doing £2.50 times 20,000, giving us £50,000. A formula triangle like we have here is very useful for remembering things that are linked with each other. So for example, if we want to calculate sales revenue in this formula triangle, we simply cover this up with our hands, and we know that to calculate sales revenue, we do selling price times by the sales volume. Equally, if we wanted to calculate the sales volume, again, we cover this up with our hands, and we do sales revenue divided by selling price, and that gives us the sales volume. Remembering these formula triangles will be a useful way of remembering how to calculate 3 different types of items. So, have a go yourself. Footy & Co sells footballs at £7.45 each. In a month, they sell 234 footballs. Calculate their sales revenue for the month. Now try this one. Charlotte sells soft toys priced at £4.25 each. The average sales per month in 2010 were 220. Calculate their revenue for 2010. Did you get it? The first one was £1,743.30, and the second is £11,220. It's important to remember that in this case, that you're not calculating for the month here, but you're calculating for the year. We started looking at costs previously. So remember, TC is total costs, and we calculate this by doing fixed costs plus the variable costs. Fixed costs are costs that do not vary with output in the short term. So we're looking at a time period of less than a year. So what we mean by fixed costs is something that does not change no matter how much we produce. Variable costs, on the other hand, do vary with output. So they do change considering how much we actually make of a product. And semi-variable costs are costs that combine elements of fixed and variable costs. But at this level, you do not need to pay too much attention to this. In order to classify the costs, we need to understand how changes in the output affect the cost of production, and to calculate the cost of making a particular product in a multi-product company. In the short term, fixed costs cannot change. Whether output increases or decreases, there is no effect on fixed costs. For example, a managing director's salary or the rent that is paid. So if you are renting a building, the amount that you pay is the same no matter if you produce one product or 1,000,000. The rent is still the same. So it is a fixed cost. A variable costs change with the output. So if 20% more output is produced, then it's assumed that we need 20% more labor, 20% more components, 20% more raw materials. So I want you to think now, how does this actually affect total costs? Well, here's an example. Output is currently 100 units. Assume that fixed costs are £400 and variable costs are £6 per unit. This simple table below shows us what happens if output increases or decreases by 20%. Note that at 100 units of output, fixed costs are £400. Variable costs are £6 times the 100 units, giving us £600, giving us total costs of £1,000. If the output rises by 20% to 120 units, fixed costs remain at £400. Total costs would then rise to 120 units times the £6, giving us 720, and therefore total costs would rise to £1,120. If units of output fall to 80 units, fixed costs stay the same at £400. Variable costs fall to 80 times £6, giving us £480. And total costs would therefore fall to £880. So to calculate profit, we need TR, or total revenue, minus TC, or total cost. As a result of this, we know that to improve profit, there are two main methods. We need to have a look at increasing our sales revenue or decreasing our costs. So now you're caught up on the terminology, let's have a look at sales forecasting. Sales forecasting is the predicting of future sales volumes and trends, and they have many purposes. So to start off with, financially, it helps us to inform cash flow forecasts that we're going to look at next time. It helps us to predict the sales volume and sales revenue, assess the ability to break even. This is the point where the total income of the business is the same as the total costs. And it helps us to set budgets to understand how much money we have to spend at certain points during the year. Sales forecasts are also of interest to the marketing department. So they help us to identify when a promotional activity is needed before a potential peak or to avoid a dip. So for example, Coca-Cola every year produce a big advertising campaign around Christmas time during the winter when their sales are particularly poor. By using a marketing campaign, that can help us to avoid a dip and try and ensure that we have a balanced level of sales throughout the year. In addition, this helps us to plan distribution of the product. When should we be when and where should we be putting the promotional campaigns? It also helps us to understand the level of staffing that we need. So it helps us plan the workforce for the sales team. When do we need to encourage the sales team to up their game during particular periods? And when will we expect the sales team to be particularly busy? And will we need more sales staff available? This is particularly important for seasonality and for peak times. So Coca-Cola, for example, would expect to have less sales during the winter and less staff. But during the summer, and during particular peak times during that summer, we'd expect staffing levels to recruit staff on a temporary basis to make sure that supply meets demand. This also helps us with resource management, ensuring that our suppliers can make sure that they provide us with enough materials to ensure that we can fill our orders, making sure that we don't have too much or too little spare stock lying around, and making sure that we can meet the right level of output at different periods of time. In addition, we can have a look at consumer trends. So goods come in and out of fashion, and it's really difficult to predict when this next big trend will be. So we can follow experts such as London Fashion Week as an indicator of short-term fashion trends. This will help us to predict sales, as if something is predicted to be in trend, we then expect sales to rise. We can also look at shopping habits. So particularly online sales, or through the use of Tesco Club Card, Sainsbury's Nectar Card, these loyalty cards and online sales figures will help us to understand who buys what, from where, and when. This is particularly important for companies such as Tesco, who use their club card in order to understand what stock should be available when. We should also consider changing demographics of a nation. So, for example, the UK is an ageing population with high net migration. This may mean that there's a reduction in the amount of children within the nation, so if we are selling children's toys, we'd expect sales to fall. On top of this, we can have a look at the actions of our competitors. So if a new competitor is entering the market, we'd expect our market share to fall and therefore our sales to follow. However, if a competitor is leaving the market, that gives us a chance to pick up on their customers, so our market share should rise and therefore our sales should rise with it. We should also consider changes in price and promotion of our competitors. So we must consider what would happen if a competitor lowers their price or increases promotional activities. That may affect our level of sales and therefore would affect our sales forecast. We also need to have a look at whether the competitor is better able to respond to consumer trends. If our competitor is more flexible and able to quickly respond to changes in our consumer wants, then they may be able to pick up on sales that we were unable to, and therefore our sales will fall and customers will leave. We should also have a look at economic variables affecting the sales forecasts. If interest rates are low, this encourages consumers to spend more as the reward for saving is low. In this case, we'd expect the sales of our product to increase. We can also have a look at employment. So, if people don't have jobs, how can they be expected to buy our product? The more people that are in employment, the more people that will have an income, and more people that will be able to buy our good or service. We can also have a look at consumer confidence. If people are expecting the economy to fall, and maybe for them to become unemployed in the future, they will look at cutting back. And therefore, when consumer confidence is low, we'd expect that consumers are more cautious, and therefore our sales would fall. Linked to all of these variables is the stage in the economic cycle. If the economy is recovering, then consumer confidence will be higher, employment will be rising, and we'd expect the sales to rise. However, if the economy is in recession, we'd expect that consumer confidence to be low, unemployment to be low, and therefore our sales will decline. This was particularly present during the financial crisis and the ongoing economic difficulties in the UK, and you can see this on our high streets with the number of firms that have closed as a result of falling sales. Now, sales forecasting is particularly difficult. By definition, the future is unknown and therefore uncertain. There are many events that we can consider, okay, and the bigger the time frame, the more difficult it is to predict. So, for example, the unpredictable events such as election of Donald Trump and Brexit have caused an increase in the ever-changing external environment and making sales forecasting more unpredictable. Furthermore, the past is not a clear indicator of the future. Things that have happened before do not guarantee that they will happen in the future. For example, the American Alan Greenspan stated that the economy would never ever collapse because of the success that they'd had in the past. However, we now know that to be untrue. In addition, we can have a look at lack of perfect information. So particularly as a business startup, we'll be using information based on other businesses. Other businesses are not the same as ours. So we'll be dealing with information that may not truly reflect what we'd expect if we were to start our own business. As a result, the sales forecast can only be as good as the information we receive and the skill of the person doing it. That is all for today. I hope you enjoyed the lecture, and I look forward to seeing you next week.